So, as the US heads toward a government shutdown, what's it doing to investor confidence? Well, Stuart Thomson heads a fixed income fund at Ignis Asset Management, which oversees £75 billion in assets. He joins me live now from Edinburgh. Stuart, good to see you. Thanks very much for speaking to us. So how much concern do you gauge in the markets right now about the possibility of a government shutdown in the US?
I think there's greater concern outside of America. America's seen this before, but this time round we've gone through 9 years worth of dollar depreciation. In that period, the Fed funds has averaged 2.16 and headline inflation's averaged 2.35. So the dollar hasn't been a good store of value. If we then have on top of that the inability of the authorities to make even modest cuts in the budget deficit, then it will damage credibility further and weaken the US dollar.
But why greater concern about all this outside the US?
I think that the US, as I say, the US has seen this before, went through some shutdowns in the 1990s. It was quickly resolved. You know, we know that politicians go to the edge of reason, but they very rarely step over the edge of reason. And there is a desire amongst the electorate for them to reach an agreement here. And the gap is so small that we think there will be an agreement reached. But it's international investors are concerned about the signal this shows in terms of the dollar's credibility.
So which asset class, with that in mind, which asset class gets hit the most in the event of a shutdown, Stuart?
Well, I think it has to be the dollar itself, followed by the Treasury market, since that is what foreign central bankers are holding as their reserve asset of choice.
Could bond markets rally in anticipation of more fiscal discipline, as they did when there was a government shutdown for, I think it was 21 days in 1995?
Well, I think in this case, this is just the first hurdle. We still have to get through the debt ceiling and the 2012 budget, where the Republicans are demanding much more fiscal austerity. Today's agreement will be over $40 billion worth of cuts in a deficit which is estimated to be $1.3 trillion. So it's only a minor tightening that we get now. And the top trouble taken to get $40 billion worth of cuts means that the next two hurdles are going to be set much higher, and the markets are going to demand more austerity through that.
Yeah, from what you're saying, the final solution to the debt ceiling debate will just be more debt.
Well, America does have a very large budget deficit, and it's only making baby steps towards reducing it. We need to see much greater fiscal austerity, but that does mean that US economic growth in 2012 will be slower than 2011.
Stuart, I was just speaking to another guest of mine in the previous hour, Lothar Mentel. He is extremely positive when it comes to the US right now. He says they have a real competitive advantage. If we don't see enough fiscal austerity, enough effort to bring down that deficit, what do you fear could happen in the bond markets over the course of the next year?
Well, I think the bond markets will be concerned. I think we will see bond yields rise over the next few months. American economy is doing well, and we would expect it to accelerate into the second quarter before the fiscal austerity and the ending of hyper-accommodative Fed policy takes place around the middle of the year.
Stuart Thomson, Ignis Asset Management. Great to talk to you again. Thanks very much.